Sandeep Tandon, you've been debating before budget that markets will be choppy in Feb. Now that we've seen a sizable correction, and a correction like what we saw yesterday gets the fear of God once again back. When you see stocks fall 40-50%, everybody starts praying hard. Is it time now not to pray but to buy stocks?
So up to a certain extent, we think we are again very close to a trading bottom. So keep in mind that like I have talked about that 2022 should be remembered as one of the most volatile year. It's a part of volatile expansion cycle which has been talking about as compared to 2020 and 2020 calendar year 2020 will be extremely volatile, which means that you have to capitalize on a shorter moves, okay, in the market. And I have always said that like global liquidity peaked out in September 2021, and the real impact of declining liquidity you will felt after 6 months, 8 months, okay. But the good news is that in this market, an employed vol spikes very sharply. Look at what happened in the month of January. The VIX shot up to 36, 38% and settled back to whatever 16 odd percent, okay, or 15-16% range. I'm talking about US VIX. Something similar, the VIX is now trading around 28-29%. I think it can spike to another 5-6%, maybe back to 36-37%, and it will happen very fast. So it's like a next 2 or 3 trading session. I believe that VIX should also settle down, start drifting down, and so is the case for the India VIX was also around 23, has potential to go to 26 or so. So maybe we are very close to a trading bottom. From a near-term perspective, in next 2 or 3 trading session, ideally market should bottom out. I have always said that, this is the year when the fear is extremely high. You should try to participate, and whenever there's a confluence, you try to tone down your exposure. That's the way you can make money in 2022. It's going to be extremely difficult year.
Sandeep, what are the chances on a scale of 1 to 10 that in this year I will not use the term a new high on the Nifty?
So I think whatever data points based on our quant predictive analytics model, which we're looking at, I have said earlier also in January, there's a very high probability that by March, you will see a lifetime high again. Okay, so I'm not ruling out, because we have always said that easy phase of bull run got over in September 2021. Okay, but for emerging market, we are still in bull run, but we are in difficult phase of bull run. Okay, I have to, why I'm making this statement based on a couple of data points which we talk about. First of all, the emerging market currencies are relatively very, very stable. If you look at whatever happened in January and what happened now in the month of February, global volatility in the equity market is substantially higher as compared to currencies market. Rather, some of the emerging market currency, we talk about Brazilian real has appreciated, South African ZAR has appreciated, Mexican peso has appreciated, okay. So some of the emerging market currencies actually appreciated, and currency gives you first signs of disturbance. So currency markets are not giving me any signs of disturbance that we need to be worried about. I have always said that 2021 should be remembered at the peak of global liquidity and peak of risk appetite. So September 2021, these are the data points we peaked out. But if I start comparing the developed market versus emerging market, then it's a very interesting data point, where the liquidity and the risk appetite for US market or the developed market was at lifetime high or decades high, which was not the case in emerging market, which is not the case, particularly in Asia-centric emerging market. So Asia-centric emerging market looks far, far superior as compared to emerging market basket also. And obviously, India will qualify in that. India has been an outperformer in that category, and I think continues to believe that. The only challenge is that how well you restructure or rebalance your portfolio. That is the challenge for 2022. Making statement is very easy, but in practicing these things is extremely difficult task, because it's so volatile and data keeps on changing in a so dynamic manner. And that is something we need to worry about it. And if we can play it right, I think you will still going to make good amount of money in September 2020, by December 2020.
Sandeep, the street seems to be fairly divided when it comes to the entire PSB versus private sector banking space as well. Just earlier, we were chatting with Ajay Srivastav, who alluded to the fact that SBI definitely is an outlier within the space. But if one is not opening bank accounts with some of the PSBs, then they are only trading plays and you don't need to invest in them for the long haul. What's your thesis when it comes to the PSBs, given the kind of returns that we've seen of late?
So I think I have been talking about that right from September 2021 itself, that 2020 is all about value. Okay, so value will outperform growth stocks globally, and the trend has already started. And PSU banks qualify in that value basket. Okay, obviously in last many months, even some of the private sector banks also have corrected a lot. They also can qualify, but on relative basis, okay, I still believe if I have to take a next 3 to 5 year horizon, not even slightly longer horizon, I think PSU banks have potential to outperform private sector bank with a substantial margin. Okay, and you have to identify the leaders in that category. So we are more constructive from the value thesis. They are grossly under-owned, under-researched stocks. Okay, and from the biggest worry on the street is right about the FI exposure and global volatility. So people tend to be avoiding the FI overowned stocks, and all the private banks are grossly overowned by the most of the FIs. Okay, and that is another area of worry, not from the valuation point of view or the fundamentals data point of view, but it is more from the demand supply issue. Okay, when supply is significantly high or expected supply is supposed to be high, the perception changes, and needs to be very cautious about that.
Sandeep, what about, the opening up trade? Look at where we were just last month and where we are today. You've got, multiplexes, restaurants, hotels, offices opening up. What's the view on this reopen trade, and which would be, some of the sectors that you'd bet on that have been beleaguered or badly hit on account of the pandemic that now are showing signs of recovery?
So I think we obviously remain very constructive for this space, but it's not going to happen overnight. Like in today is a problem which I see with this generation. And people tend to overreact. When market started rallying, people tend to chase, and suddenly so there's urgency to buy and there's urgency to sell. With this background, I think the hotel stocks looks definitely very attractive. I'm not sure about the media from the PVRs of the world, whether people will open up so easily, but the safe space will be travel company, airline stocks, or the airport stocks, or the hotel stock, which definitely looks not only for India from a global perspective. I think that's an area one can look, and if you find value in some of these names and you find under ownership, then it's a deadly combination.
Good morning. This is Nantara. Today, what we've seen in the market also is the IT stocks make a comeback of sorts, right? And it is being led by a Coforge, a Tech Mahindra, and a Mindtree. What we've seen in recent past is the IT stocks coming off quite a bit from their highs. Would you say that this is a good time to look at this entire pack? I know IT is always considered to be eternal, but valuations had really gone up.
So we have seen whenever we have noticed that when volatility is on the higher side of the street, people tend to participate on the technology stocks. It is considered as the most defensive name. Okay, but we have a very different opinion. We believe the perception indicator for IT stock and the growth stock has peaked out in September 2021. So as per our predictive analytics model, we believe technology stocks going globally also, I'm not talking about just India, technology stock will be not the part of our outperformance basket. At best, they will be market performer, and some of the names can be even underperformer. So, and these are the area which is very overcrowded trades are there. Everybody is convinced about it. People are talking about structural bull run in these stories. Okay, so I'm not a believer of that, because I believe that neither earnings have peaked out, nor for the IT stocks, nor the stocks have peaked out in terms of price, but definitely from the valuation multiple, whatever way you want to calculate, has definitely peaked out globally. And that's one of the reasons we remain very cautious. Okay. We believe that growth stock or technology stock have potential to underperform the market. Okay. And they definitely don't qualify for a market outperformance basket rather than, just to be a market performer. So we remain slightly cautious. So if it is not considered as a part of a core holding, I can be part of my tactical position rather than core positions.
Okay, so that's your call as far as the IT pack goes. Mr. Tandon, if I can go back to a point that Nikunj was also making right at the start of the interview, right? People getting scared with the kind of fall that you've seen. Now, a lot of the investors have, of course, made a lot of money from the broader markets. What we saw in the Nifty and the Sensex yesterday could have been masking the pain that was really there in the broader universe. I know this, you're supposed to, be a stock pickers market, look at all of that. But the sell-off that we've seen in the broader markets, are you red flagging it? Will we see a rotation coming back towards blue chips?
So let's understand from a let me talk for a minute from a global cycle first. So if you look at the money flow towards global equity, peaked out. Answer is yes. Okay, emerging market relatively better space, but within that, the way I look at it's not about how you define. It's a very subjective thing. Blue chip, sometime like if you look at for last many years, pharma and the FMCG used to be considered a blue chip and defensive name. That was not the case from 2015 for at least for pharma became most volatile stock. Okay, and look at the underperformance of some of the consumption names, so-called defensive in the past. So I think it's a very subjective. The way we look at from our perception indicators point of view of the behavior data point, we try to identify stocks which are in the most admired category. We try to prune it down and try to identify the stocks which are in the neglected and beaten down territory, if I call it neglected territory from a behavior perspective. Those are the areas which I will call it as a, defensive name. So anything which is in the neglected territory has growth potential, quantify for the valuation perspective, remain under ownership. These are the areas which I will define defensive. So it's a very subjective term. So if you want to call it blue chip or defensive, I think the definition is changing very fast and one has to be very, very careful on that.
Okay, so we are seeing new definitions that are coming in for all of this. Lovely point there when it comes to pharmaceuticals and defensives. And at a time when we've not seen the rupee depreciate the way the street had also feared. Mr. Sandeep Tandon, it's always a pleasure talking to you. Thank you so much for joining us live today on The Market.